Good morning, everyone. Good morning, sir. Today, I will discuss the domestic corporations. A domestic corporation is are tax on all income earned within and outside the Philippines. Next is expanded foreign currency deposit system or EFCDS. The expanded foreign currency deposit system allows banks in the Philippines to accept foreign currency deposit. This system helps promote foreign investment and strengthen the country's economy. Participants include non-residents, offshore banking units or UBUs. Next is local commercial banks authorized by BSP. However, however, interest income from foreign currency loans to residents is subject to a 10% final tax. Income of non-resident from this transaction is generally tax exempt. So the example is foreign currency loans. For example, the foreign currency loans situation is XYZ Bank, part of the system, lends 100,000 to ABC Company, a local business not in the system. Interest earned 5,000. Tax 10% of 5,000 equal 5 tax to be paid. 500 tax to be paid. So the result is XYZ Bank has to pay 500 tax on that interest. This is the final tax. Next is example. Next is interest from foreign currency deposit. The situation is a domestic company earns 100,000 interest from foreign currency account, tax 50% of 100,000 equal 15,000 tax. So the result is the bank deduct 50,000 tax right away. The company gets the remaining 85,000 and doesn't need to pay anything else for this income. Next is general tax rule for AFCDS. Income from this foreign currency transaction is usually tax exempt, except for the net income, which is taxed like regular bank income. Next is exception interest on loans to residents. If a bank lends foreign currency to a resident person or companies in the Philippines who is not an offshore bank or part of the system, the interest earned from that loan is taxed at 10%. For example, banks lends 100,000 to a local company and interest earned 500,000. Tax 10% of 5,000, so equal 500. So the result is the total tax the bank has to pay, especially for this interest income from the loan. Next is the tax treatment for non-residents. In any money non-resident earned from transaction with this bank is completely tax-free. So now let's proceed to tax on certain passive incomes. Section 27 EIRC. Passive income is money earned without active work, like interest, royalties, or gains from selling stocks. So, interest and royalties. 20% versus 15%. 20% final tax applies to interest from Philippines peso bank deposits, yield trust funds, and royalties. 50% final tax, especially for interest earned from a depository bank under the expanded foreign currency deposit system. So, let's proceed to interest income. So, what's it? Is the money you earn when you keep your money in a bank or when you lend money someone else is like reward for letting others use your money. This applies to bank deposits, substitutes, trust fund, and similar arrangement. For example, the situation is XYZ Corporation has saving account with a local bank under the expanded foreign currency deposit system. Interest earned 2 million from the saving account. Since the interest is from a bank under the AFCDS is taxed at 15%. So tax on interest income equal interest earned times tax rate. So total 2 million times 50% equal 300,000. So 50% of 2 million equal 300,000. This is the amount that company has to pay to the government as tax for the interest earnings alone. So next is royalties income. What is it? It is money paid to you because someone is using your property, idea, creation, or brand. This is payment for the right to use something that belongs to you. Payment for using copyrights, patents, trademarks. So, for example, the situation is XYZ Corporation licenses its software to another company in the Philippines and earns royalties. Your royalties earned a 1 million from this licensing agreement. Royalties received from sources within the Philippines are taxed at 20%. Tax on royalties equal royalties earned times tax rate. So 1 million times 20% equal to 100,000. This is amount na pay the government as a tax for that royalty earnings. So, the total tax liability ay total tax equal interest income plus royalties. So, 300,000 plus 200,000 equals 500,000. This is full amount owed to the government for both types of income combined. So let's proceed to capital gains from selling stock. If you sell shares of domestic company that are not traded on the stock exchange, the profit capital gain is taxed 10%. So this applies when you sell share of stock of a Philippines company. But these shares are not listed or traded in stock exchange, meaning they are private shares. Give the profit make called capital gain is taxed 50%. For example, profit from selling private shares is 500,000 tax 50% of 500,000 equal 75,000. So the result company pays 75,000 tax. This covers all tax due on that profit. Next is intercorporate dividends. When a domestic corporations receive dividends from other domestic corporations, the tax rate is 0% because something called avoidance of double taxations. The first corporation already paid tax on its income, usually 25% corporate income tax. If the government taxes the dividends again when another corporation receives them, the same income will be taxed twice. Say, second, from a foreign company. So money coming from abroad is usually taxed, but it becomes tax-free if you follow these rules. If you follow these rules, first, money is remitted to the Philippines. Second, revisited investment within 1 year. Third, used for working capital expenditures or investment in subsidiaries. For company owns at least 20% of the foreign company. Last, held shares for at least 2 years. For example, a company owns 25% of a foreign firm for 3 years. Received 100,000 dividends. Result 0% tax. Why? Because since they meet all the conditions on 20% held for 2 years, revested within 1 year, they don't pay any tax of that 1 million. So no tax 0% because the profit was already taxed when company B earned it. We don't tax it twice. So that's all for my report.